When you want to understand how profitable a company is, there are a few different ratios and statements that you have to look at. One such ratio, and definitely an important one, is return on assets, or ROA for short. Hey everyone, I hope you're doing well. In this video, we're going to be talking about what return on assets is, how to interpret it, and delve into how a company can actually improve their return on assets ratio. Just before jumping in, if you like content like this and want to know more about the stock market, consider subscribing to the channel and put the notifications bell on so you never miss an upload. So return on assets is a ratio investors can use to analyse a company's profitability. It's a measurement of how much profit a company generates relative to its total assets and is a type of return on investment. In other words, it shows how much profit a company generates for every $1 of assets. Therefore, generally speaking, a higher ROA would indicate that a company is more profitable and efficient with its assets. ROA is also an efficient way of measuring the management effectiveness of a company, as it shows how effective a company is at using its assets to generate profit. But, as I always like to stress, you should never base an investment decision off of one indicator. Instead, use it alongside other indicators so that you come to a well-founded, well-researched investment decision. You can calculate ROA by dividing net income by total average assets and multiplying by 100. And you can calculate a company's average total assets by adding the total assets across the chosen periods and dividing by the number of periods. The reason we use average total assets is because a company's total assets can change over time, and so it's much more accurate to use a company's average total assets over a few periods rather than just its total assets in one period. You can find a company's net income on its income statement and its total assets on its balance sheet. Let's give an example. Say Company X has a net income of $10 million in 2017 and total assets were $35 million in 2016 and $45 million in 2017. By using the aforementioned calculations, we will find that Company X has an average total assets of $40 million and as a result has an ROA of 25%. What this means is that for every $1 of assets Company X owned over this period, it earned 25 cents in profit. ROA is most useful when comparing companies either against their own history or against companies within the same sector. ROA should not be used to compare companies in different industries, as companies in different industries use their assets completely differently. For example, a bank will have a much higher ROA than an asset-intensive company such as a construction company, and therefore it wouldn't be fair nor effective to compare their ROAs. ROA can also be used to help determine if a company is asset-light or asset-intensive. If it has a low ROA, the company is most likely asset intensive, while a high ROA would indicate that a company is asset light. This is because assets are the denominator of the formula, therefore the higher the total assets are, the lower the ROA. An important question is, how can a company improve its ROA? Well, by looking back at the formula, we can easily tell that the company can do one of two things. Either it can increase its net income, since that is the numerator, or decrease its total assets, since that is the denominator. A company can increase its net income by selling more units of its products, selling a wider mix of products, increasing the selling price, and many more. A company can decrease its total assets by improving its collection of accounts receivable, leasing rather than buying outright, improving asset allocation and efficiency, and many more. If a company can successfully achieve one or both of these changes, it will improve its ROA and become much more attractive to investors. As always, I really hope you've enjoyed this video and learned something new. If you do like content like this, consider subscribing to the channel, and if you have any topics you'd like me to cover in future videos, leave them in the comments below and I'll try my best to get to them. Thanks for watching.